Hello guys and welcome. My name's Martin Jones and I'm going to present to you on AAT, as you can see if I push myself back and into camera frame. This is the London School of Business and Finance, and I probably should say this straight off. Please do forgive me if I look to the left quite a lot. I have this massive monitor with loads going on telling me what's going on and most importantly things like the microphone is on. I think the last person in this studio forgot to put the microphone off, so it's not brilliant, but there you go, the microphone is on and you can hear me, so that's fantastic. The image looks good, it's a great camera, I can see that. What else do I need to say? Nothing. This is 4 o'clock and therefore that means for me it is level 4. And indeed I'm in the level 4 studio, so entirely appropriately behind me I have the level 4 financial reporting assessment. So I've been hopping from studio to studio, going from level 2 to level 3, now to level 4, doing the accounting papers. And as you can see, what I'm moving to here is the financial statements of limited companies, and lots of little itty bitty bits, and it's quite a long task that I have. I'm not sure it's particularly difficult, but I'll have to be keen with my timing just to make sure that I do get through all of this, because I do want to get through all of this. So this paper called Financial Statements of Limited Companies, FSLC, is the level 4 paper, and it has a simulation up on the AAT website, and this task has been taken from the simulation. Oh, excuse me, just blow my nose. Oh, excuse me. Do excuse me, I'm just going to go off screen so you don't watch me blow my nose. That's not the nicest thing to do, is it? I won't run away too far, don't worry. I don't know, there's something that, when I'm teaching a class, I just, if I sneeze and blow my nose, I just sneeze and blow my nose, but there's something about being on camera. It's not the most comfortable thing to do, to blow your nose on camera. If you've ever tried, I'm sure you know what I mean. So this is taken from the simulation on the AAT website, and the simulation is taken from a 2016 examination, and the 2016 examination is recommended by the AAT as an effective indication of what is likely to be examined in 2018 and indeed in 2019. So this is highly representative of what you might expect. I should warn you that we've got 10 sessions on financial statements of limited companies. This is my 4th and final session, and Reg is going to take over for the next 2 weeks after May, and then Paul for the final 2 weeks. So there's 10 sessions, 2 weeks at the beginning, 4 weeks of May, 2 more weeks of Reg, and then 2 weeks of Paul at the end. So there's 10 sessions, but there's actually, I think it's 6 assessments. So what we have done is we've chopped up the tasks, and this task here is taken from, I can tell you actually, it's taken from task number 4. So it's taken from task number 4, but it is the 6th week task, as you can see from the highlighted circled number 6. Goodness me, let's just get on with it. Diego is preparing its financial statements for the year ended this year. The corporation tax charge based on the profits of the current year has been estimated at 42. And before I go any further with this, that is what you have to do with your guesswork as regards financial statement tax. In order to come up with a convincing and cohesive presentation as regards this idea, I'm probably going to have to be a little bit dogmatic about how things work. And as you can imagine, anything I say can be slightly different in real life depending on the circumstances. But keeping it simple, limited companies are expected to return their FS to their shareholders 3 months after the year end, keeping it simple. And the inland revenue allows you 9 months to work out your tax position. And therefore, the figure that you put in your FS 3 months after the year end is not the same as the figure that you pay the taxman 6 months later, 9 months after the year end. Therefore, it is necessary that any figure as regards the tax charge or indeed the tax liability for the current year, it is always the case that the liability is estimated. And what we did this year, we did last year as well. This year we estimated, last year we estimated. So what happened last year? The company had underestimated its corporation tax liability for the previous year by 8,000. And actually this question is not bad. Some of the questions I've been doing at level 2 and level 3 are so dry with so little context. It's like, well, what's going on? But this one has got got an entity called Diego. It's got a nice little story. But what's missing is we're not told how much we did estimate last year. But just to make up a number, say we estimated 30,000 last year, but we ended up paying 38,000 during the current year. Does that make sense to you? So at last year's year end, we put in a liability 3 months after the year end. We signed off the FS, and that had a liability in the last year's FS of 30, and then 6 months after that we paid 38. Perhaps it does help with my hands up. So what we estimated last year was reasonable based on what we knew 3 months after the year end. But after 6 months of negotiation with the inland revenue, we ended up paying 8 more. So we underestimated, just checking I got the under right, yep. So we underestimated, and this happens. But if we'd underestimated the liability, it also means we'd undercharged in the P&L last year. And when you undercharge in the P&L last year, you put in the extra charge this year. And that's where we start the question with that background information. I'm bouncing from studio to studio, as you've just heard. And therefore it's really useful if I've got some cheat notes next to me. Otherwise I tend to get a bit punch drunk, to be honest with you. So I've got my cheat notes here, which just remind me the kind of things that I should be saying. Lots of pages, aren't there? So here we go. According to my cheat notes, I'm not supposed to say much about this. So there we go. Let's not say too much. What amounts should be shown in the financial statements for the year ended this year in respect to the corporation tax charge and the corporation tax liability? The corporation tax charge should be 50. Indeed it should. Oh, nice. Oh no, what's that doing? Just give me a second. I think the pen is on pressure sensitive, yeah. So the charge is this year's charge of, what was the figure? 42. Plus the underestimation. The underestimation is often called an under provision. And if we undercharged last year, we need more charge this year. So the 8 is added to the 42 to give us 50. There it is there. There's all sorts I could say here, but we do that because that's the law. There's one way of saying what we do. The corporation tax liability is 42. We're just over 42. You know, this is what we owe. we estimate we owe. Not quite sure why I'm writing that out. Why can't I just say it with my mouth? But for some reason I feel like picking up a pen and writing out that story. We don't owe the 8. The reason we know that we had an underestimation last year is because we estimated 30 and we paid 38, but we've paid the 38. The reason we know about the 8 is because we've paid not just the 30 we estimated, but the 8 on top. We've paid it. We don't owe it anymore. So the corporation tax liability is just what we still owe. Lots to do, so let's keep going. Oh, a new entity. Dallas Limited purchased a motor vehicle on the first day of the current year for $36,000. The vehicle is expected to have a useful life of 4 years and a scrap value of 4. It is depreciated using the straight line method. The company prepares FS to 31st December. How much depreciation should be charged in the statement of profit or loss for the second year? Well, the depreciation is the same in every year. So I think I will do it just like this. Depreciation is equal to the 36 minus the 4, which gives us 32. 32 has even got a name, it's called the depreciable amount, and we divide that by 4 years. So 32 divided by 2 gives us 16, 16 divided by 2 gives us 8, so it's 8,000. In 2001, 2002, 2003 and 2004. And this happens to be the second year, but the depreciation in every year is the same. Okay. Memphis now, we've knocked that one out very quickly, so we're moving on. A machine owned by Memphis Limited has suffered physical damage and might have become impaired. The following information is relevant. Oh, remember this one. This one's nice. This one's got more substance to it. At what amount should the machine be recognised in the statement of financial position? So what we have is called an impairment. And an impairment involves us, I think I'll answer this in full actually, as identifying the carrying value before the impairment, which is 20, then recording an impairment down to the new carrying value, which is what's been asked for. And this is the closing carrying value, or the carrying value after the impairment has been recorded. At what amount should the machine be recognised in the statement of financial position? So how am I going to present this? I'm going to present this with a little arrow going like that. There you go, like that. Now, an impairment compares the recoverable value to the carrying value. And the recoverable value is the higher of value in use and fair value less, fair value, missed a letter there, fair value less costs to sell. And as you can see, the fair value is 8,000 and the cost of disposals are 0.2, so 0.2. And therefore the fair value less cost to sell is 7.8. Actually, I've not lined that up very well, sort of half-heartedly lined it up. So 7.8. But it's the higher of these two. The value in use is very slightly more, actually, not much more, at 9. And what we do is we take the higher 9 and record an impairment of 11 as a balancing figure. And that's it. In this particular case, it says, what amount should the machine be recognised in the statement of financial position? Well, the answer is 9,000. 9,000, like that. Oh, I seem to have people joining me, so I'll just say some welcomes to people. I'm struggling to see all the names, but my apologies in advance if I've missed your name. But welcome Ahad, welcome Mba, welcome Shabazz, and welcome anyone else who's watching this. And I can't see your name, my apologies. And welcome anyone who's watching this as a recorded product. Welcome. Now, there's definitely more substance to this than what I've said so far, so I'm going to take this a little bit further. The reason we're doing what we're doing is because this is what the standard says we should do. However, the standard, unlike some standards, this standard is based upon logic, so that it does actually make sense. What the standard says is you compare the carrying value to the recoverable value, and if the recoverable value is lower, then you record a fall in value known as an impairment. And that is what we've done, isn't it? But recoverable value is a beautiful phrase and completely literal. Recoverable value is the value you are able to recover. And what can you do with any asset? I've just put the pen down, but I'll pick it back up again. What can I do with this pen? Well, nothing. It's not my pen. But imagine if it was my pen. What could I do with this pen? What I could do is I could sell it on eBay, or I could use it. In order to work out the value in use, you have the challenging job of doing a discounted present value on the use that you get out of the pen. Which is not an easy thing to do, but that is nevertheless the truth. The value in use is the discounted present value of the cash flows that come from using the pen, and the fair value less cost to sell is what I could get for selling this pen on eBay less how much I would have to pay eBay to make the sale. So, for example, believe it or not, these pens are quite valuable. It seems unlikely, doesn't it? But they are. I might get £50, but I have to pay 10% to eBay. The fair value, therefore, would be £50, but the costs to sell would be £5, and therefore the fair value less cost to sell would be £45. Now, say, for example, there was a value in use of 190 and a fair value less cost to sell of 45, what that is telling me is I've got a choice between £190 or £45. Now, which would you prefer? £190 or £45? 190 all day. Exactly, that is called, it's got a name actually, that's called rational human behaviour. And that rational human behaviour is reflected in the standard, which requires us to use the higher. So we choose the higher for the carrying value because we choose the higher strategically in our business lives. That's that done. Moving on to the next question. Denver sold goods for $40,000 plus VAT at 20%. The company also issued 10,000 ordinary shares at par. How much revenue in total should be recognised in the statement of profit or loss in respect of these transactions? 40,000. When we make how much you only it's like some fairly obvious stuff here. You only so we get rid of the 10,000 first of all. You only record a sale when you make a sale, and when in order to sell something, you need to sell a good or a product. When the company issues ordinary shares to its owner, what all that means is the owner's taking money out of their pocket and chucking it in. So it has got a name, this, when you take money out of your own pocket and chuck it into the business. It's called capital introduced. It's from your perspective, when you take the money out of your pocket and chuck it in the limited company, it's called capital introduced. And when they receive the money from you, that's called capital introduced. It's got the same name in both directions. So from the point of view of Denver, it's just receiving cash from its owners. That's not a sale. To sell something, you have to sell something, and we've sold some goods. But how should goods be recorded? Well, the VAT is nothing to do with our sales. It's just when you operate in this country, this political organisation known as the United Kingdom, the law says you have to slap some tax on top and collect it on behalf of the government. So it's £8,000, isn't it? That £8,000 that we collect on behalf of the government has nothing to do with us. We're just the middleman between our customer and the taxman, so we just sort of pass that along, right? It's not our sale, it's just what we slap on top to collect it on behalf of the government. It's the government's tax receipt, it's not our money at all. So, no, not the VAT, and not the 10,000, which leaves the sale being recorded as a sale. Fine, next. Which of the following costs, if any, should be included in the cost of inventories? Can you read that? Yeah. Of a finished product held in a distribution warehouse at the end of the year. And the best answer is, which of the following, if any, should be included, not excluded, but included? Well, transport costs to the warehouse should be included. Oh, do you know what? I haven't given the definition. So, just for a second there, I was just thinking, I was going straight to the answer rather than telling you how I was getting the answer. So, cost has a definition. It is all the past expenditure in getting the goods to the present location and condition. And it's not a great question, this, to be honest with you, because it hits on a really techie part of the related standard. Where, you know, let's just check this out. Where are the goods? Where are the goods? Where does it say? Cost of inventories? Oh, it's in a warehouse. Right. So the cost of getting the goods into the warehouse was obviously part of the cost of getting the goods to its present location. So that is included. So that fits. The costs of getting the goods to their present condition are manufacturing costs, and there's no discussion of manufacturing costs here. So, what should we do here? Yes, these will be manufacturing costs, and it doesn't apply here. But going back to present location, oh, this is just, I find this really, really, really dodgy. Maybe the only way to do this is for me just to give you a timeline and just show you what it is that the standard is doing. Is so here's the year end, and here's a little arrow for it's a bit what's the word, dogmatic, to say the least. But once the finished goods are in the warehouse, the law is we close the T account. That's what the law is saying. Can you see that, or have I made that disappear behind my head? I'm almost running out of time, so let's highlight. This is the storage costs. The storage costs are after we've closed the T account. The asset was already in its present location Once it hit the warehouse, then you close the T account and the storage costs go straight to the P&L because you're not allowed to put them on the asset. Therefore, it is 2 only. That is how the standard works. There is slightly more to it than this, and I could go into great detail, but that is the simple analysis of how this works. Well, that was quite a lot in 25 minutes, wasn't it? So I better go big head and summarise and say thank you. So thank you very much indeed for listening to me. My name is Martin Jones, and I've been presenting to you on Level 4 Financial Accounting. I'm just going to get the exact name off the top of the document. Financial Statements of Limited Companies. Please apologise for me. Please accept my apologies for looking down, but I need the prompt. I wish you very good luck with your studies, and if I can be of any help to you at all in your studies, then please feel free to email me. My name's Martin Jones. This is LSBF TV. I wish you good luck with your studies. See you soon.